Uh, Good afternoon. I think we're live. Yes. Good afternoon. Welcome to this discussion on digital money, monetary sovereignty, and financial fragmentation. My name is Simon Nixon. I'm an economic commentator, among other things, the publisher of the Wealth of Nations newsletter on Substack, and a governor here at NISA. This is obviously a huge and important topic, albeit one that recently has been largely ignored by mainstream economics, the financial markets, and media. It's nearly 20 years since Bitcoin was launched. And for much of that time, most people have tended to think of crypto and digital money as, at best, esoteric, and at worst, in the words of Donald Trump, the greatest scam of all time. What has changed, of course, is not just that Donald Trump has worked out how to make $1 billion for him and his family from crypto, but his administration last year introduced the Genius Act to bring crypto right into the financial mainstream. So now everyone needs to understand it. For the purposes of this discussion, we're going to focus solely on one form of crypto, which is stablecoins, since this is what is being brought into the mainstream by the Genius Act. These are digital currencies that are designed to maintain a steady value pegged to a reserve asset such as a dollar and are backed by 100% reserves in short-term treasury bonds. To that extent, they are simply best thought of as money, no different to the money in your pocket or your bank account, but simply in tokenized form so that they sit in your digital wallet. But obviously, it's not quite as simple as that. A world of stablecoins could have profound ramifications for other issuers of money, central banks and commercial banks. Some estimates suggest that the market could grow from $300 billion today to $2 to $4 trillion by 2030. So hence our focus today on the implications for monetary sovereignty and financial fragmentation. Since there's a lot of ground to cover in an hour, I've got a list of questions that I am going to put to the panel. Hopefully they'll keep their answers succinct, as I'm keen that we should have 10 to 15 minutes at the end for audience questions. If you do have a question, please put them in the chat, and when the time comes, either we'll unmute you so that you can ask it yourself or I can ask it for you. With that, let's crack on with the discussion. So my first question is really just to sort of setting the scene is, are stable coins socially useful? Does the technology offer businesses and consumers functionality that's not available with traditional forms of money? And I'm thinking here sort of programmable money and other characteristics of digital money. There are sort of technological characteristics here that are slightly different. And so perhaps we could just talk through, whether there is here a killer app for the financial system. So I didn't introduce the panel to you, but you have Richard Porter, Professor of Economics at London Business School, and a honorary president of the Centre for Economic Policy Research. David Andolfato, Professor and Department Chair of Economics at the University of Miami. Beth Haddock, founder of Warburton Advisors and Global Policy Lead at Stablecoin Standard. And James Mosley, UK Digital Assets and Crypto Risk and Regulation at PwC. So that first question, are stablecoins socially useful? I'd love to hear your thoughts on that, Beth. Do you want to lead us off?
Absolutely. And thank you, everyone, for joining us today. I look forward to the questions and thank you for inviting me to join this wonderful panel. I'm going to start by maybe responding by questioning the assumptions behind the question. So when I think about are stablecoins socially useful, I think in there's an assumption that the status quo and the legacy financial system is actually delivering what we need. And I'd offer that stablecoins are socially useful to intermediaries because, in fact, they're addressing some issues with the legacy system. So I'm sort of going to focus on the cost and the speed and the risk of moving money globally and how stablecoins can solve for those issues. And when we think about why do stablecoins matter, I think about the financial crisis in 2008. I think about a current lack of trust in institutions. Whenever I have this discussion or any discussions about trends and what we see as the future, I always like to see three generations discussing it. And I do think if Gen Z or some of the other digital native generations were here, or hopefully they're in the audience, we might see what I'm offering up as something that really resonates with that generation. So let's just quickly take a look at cost. When you think of international remittances, really between like 6 and 7% of small transfers, and it's really not marginal, end up being the cost. Now, one of the benefits of payment stablecoins that are global is that that cost can be eliminated for low income households and for migrant labor. So when we think about our current state and some of the geopolitical issues, we think about funding conflicts. One of the promises of having new rails that are lower in cost potentially could help us to fund prevention of conflicts instead of actually those conflicts. Now, I know a lot of what you'll hear from me and perhaps others is an optimistic look at the future, but it really is grounded in understanding that the next generations want to see a different financial system. So you can see SpaceX and many of the new issuers of stablecoins are thinking about the usefulness is not a retail killer app, as you had mentioned, which is for those that are interested, that was a reference from the 2024 A16Z annual report on crypto. And I do think it creates a misperception. I think the most useful, at least what we're seeing with the new issuers coming to market, is the institutional benefits for managing corporate treasuries. So when you think about an example of SpaceX repatriating funds from countries with volatile currencies like Argentina or Nigeria, it's also an easier way when it comes to cost and time to pay a global workforce. So there are some innovators like Scale AI that are using stablecoins to make faster, cheaper payouts. And when you think of the legacy use, even for video games, to use different gift cards or those types of uses for global transfers of money, those are some of what I would see are going to be changes and why it is a breakthrough. The risk that we think about when I think of end users and corporates, when they bear the cost of the time, where it routinely can take several days to settle, particularly business to business transactions through multiple correspondent banks. And that risk is really on the users or the corporates without much compensation, especially if you think of overnight cash sweeps. So also when I think about programmable money, what I'm really thinking of and discussing today are payment stablecoins, which are wholly regulated prudentially. I'm on the board of a stablecoin issuer out of New York. And as you mentioned in the intro, also a global organization for issuers and different service providers to the whole ecosystem. And when I think of stablecoins, I do want to sort of before I wrap up, just sort of address two misconceptions. The first one is that there isn't any value in stablecoins if you're not using them at the grocery store right now. I'd say the real optimistic value is changing the rails. So, for instance, having a swifter way to analogous to like paper-based messages versus Swift, or these are the roads, the rails. I don't think of stablecoins as other cryptocurrencies that are speculative. I think of them as sort of the roads where others will come in as service providers, innovating, let's just say, to carry the analogy over with they'll build the vehicles, the businesses, the roadside attractions. So stable coins, I wouldn't conflate and have them be more than what they are in the current and proposed global regulation in Asia, in Europe, and in the US, which is really just this Rails function. The the other misconception I would say is that payment stablecoins are just that. They are not tokenized deposits. They are not intended to be used as bank deposits. There is an evolving product development, which is interesting and potentially could have the same benefits of lower costs and speed. However, they're distinguishable. Stablecoins are not meant to replace or to act like deposits. Thank you.
Okay, thanks very much for that, Beth. So does any panel want to come in? James, did you want to say something on this?
Sure. I mean, no, thanks. I mean, maybe just very briefly. I mean, I completely fundamentally agree, Beth, with sort of your point around the payment rails and these as an enabler of something else, and the way to sort of look at stable coins, and the remittance market. I guess just to add a couple of extra points. I mean, first, if you look at the stable coins in issuance and in use today, outside crypto traders, I would guess that a large share of those are in Latin America and sub-Saharan Africa and less developed economies where there are challenges with local currency volatility, currency controls, and they've replaced a very expensive process of going through FX merchants to get access to dollars, which I think undoubtedly is doing social good in those countries for end consumers. I think, building on your point, but I don't see people in England going around and paying for stable coins with their credit card tomorrow. There's no ultimate utility to a consumer. But I do think what it unlocks as those payment rails is phenomenally powerful. And one of the things sort of I'm more passionate about is the tokenization of real world assets and the democratization, for example, of access to investment products, which can be enabled through on-chain tokenized formats paid for by stablecoins. I guess I'll make two more points. One maybe slightly more controversial because I appreciate the jury's out, the press isn't always on the side of it. But the reality is the technology also helps to some extent with financial crime, and being able to track and prevent challenges. Because unlike briefcases full of US dollars or sterling, it is to some extent trackable. There are still ways of hiding it, but arguably in a regulated framework, stablecoins give you that audit trail and give law enforcement authorities more power to source funds. And we saw some of that, for example, on freezing stablecoin assets after the Bybit attack by the Lazarus Group last year. But then finally, what I would say, just to slightly contradict myself, and I'm misquoting, I think, the governor of the Bank of England, who wrote this 6 months ago in the Times. You could still see these as a dangerous, I think, in his mind's detour on the path to true ideal programmable money, and digitized formats. I think it's a very useful, very fast way of replumbing and fixing some of that legacy payments infrastructure today, but it's not necessarily the ideal end outcome and doesn't necessarily fully enable on its own all those killer apps and use cases you referred to, Simon.
Okay, thanks very much. Um, so just thinking about the sort of the differences between stable coins and the current sort of payment system, commercial bank system. Most of the money in circulation in the world today is commercial bank money, which is backed by a wide range of risky assets. Yeah, Rich, I was going to come to you in a second. I was coming to you now. Yeah,
Okay.
but so my sort of question is sort of why all the anxiety about stable coins, which are backed by the safest assets. I was going to come to you, Richard Hibbs. I'm sure you also might want to come back on uh, some of the points that were made earlier. But so yes,
Oh,
Richard.
yeah, I do. Indeed. And I don't represent an issuer. I don't represent the private sector. I'm just an academic, and I have no stake in this personally whatsoever. But if we talk about Generation Z, my 19-year-old daughter doesn't seem to find any difficulties with dealing with the financial system as it is, hasn't complained in the slightest, and is not particularly interested in using stablecoins, nor are many people. And I think the point is that here that compare the US and Europe. The US has very inefficient payments technologies, that's for sure. Europe, not so inefficient. And I can make a transfer from my bank to an Italian bank very quickly, the delay being only know your customer and anti-money laundering. Now, what about that? If the stablecoin transfers had to satisfy AML and KYC, they would be a bit slower, no? And they might be a bit more costly. So the idea that it costs 6 to 7% for me to transfer money to an Italian recipient is just fanciful. It's nothing like that. The hype here about stablecoins right now, everybody's, all these projections, accelerating growth. Actually, growth stopped in October, plateaued at about 350 billion total issuance, and hasn't risen since. So maybe those projections of stablecoins dominating the world are not accurate. And as far as technology is concerned, we have, in the UK at least, we have standing orders, we have direct debits, programmable, if you like, programmed means of transferring funds. Why do I need to have a smart contract out there? No, not at all. So I think that the hype is excessive, that it's going to calm down, and we'll come back to this, I'm sure, later, and that ultimately, not so long, not so far from now, stablecoins will be dominated by tokenized bank deposits. We'll come back to
that. Great, thank you. Well, so I'm still keen to get your you and other panelists' thoughts on whether we should be thinking about stablecoins as being, financially risky, given that like commercial bank money, they're backed by very safe assets.
Are they really? I see. So money market funds are safe assets in the sense that you can liquidate them immediately? No, you can't. And so if there were a run on a stablecoin, they could not be the holdings which are permitted both by the US and by the European Union right now. I think a big mistake in the EU, but they didn't ask me this time. Liquidating a money market fund, if there were a run on a stablecoin, liquidating money market fund holdings doesn't happen overnight, doesn't happen immediately by any means. So, and there, then you get to Tether, which is holding gold, which is holding Bitcoin in its reserves. Give me a break. And actually, when you say the safest assets, Simon, U.S. Treasuries are not so safe anymore. The Treasury market has exhibited dysfunction several times in the past few years, and a major effort to unload Treasuries to deal with a run on a big stablecoin could be highly disruptive. And it's not clear that in its current state that the plumbing of the Treasury market could handle that. So I think that the safety of the assets is not obvious. As far as if you then compare with, say, tokenized deposits, banks are backed by the FDIC, by the Bank of England, by deposit insurance, and so forth. No such thing with stablecoins. Not yet, anyway, thank goodness.
Thanks, Richard. Well, can I put this to you then, David? I mean, some people have warned that stable coins risk a return to a kind of 19th century style financial system where you have competing private sector coins trading at different values and undermining the wholeness of money, as the BIS put it in a report recently. I mean, do you share that concern? Do you share Richard's concern, or does the current proposed regulations address that risk?
Yeah, that is, I think, a bit of a concern, I suppose. People harken back to the 19th century, especially in the United States, with thousands of different banks issuing different dollars, different banknotes, trading at discounts relative to each other. I'm not sure if it's that something that I would be overly concerned about. I mean, there is a sense in which we should let, I think, especially in the United States, is to let competition prevail and let the best money win. In regard to Richard's observation that bank deposits are insured by the ways, I wanted to just comment on that. They're not limited. They're not insured fully, Richard.
No,
And so I think that for these stable coins, you mentioned that the demand has seemed to be stalled, but I think as policymakers, we have to worry about contingencies, especially entities like Tether that are incorporated offshore British Virgin Islands. I
also,
think that there is some, the scare scenario there for me is, you might have these multiple types of currencies coexisting. That's always been the case. But in the case of Tether, which is the largest stable coin in the world, the vision I have is at some point it becomes kind of a rail that's used by corporate treasurers to kind of facilitate the global, supply chain payments. Um, but then on the other hand, you mentioned also the problem of runs. One thing that I find interesting in the United States under the Genius Act, and I think Tether as well, is that the par redemption isn't actually a statutory. It's contractual, and it's kind of limited to large issuers. So in the literature on bank runs, like how to prevent bank runs, Diamond Divig literature, I'm thinking of the ability to suspend payments. The credible threat of that is supposed to kind of discourage kind of the run phenomena you're talking about. And in any case, even Tether, for example, its custodian is in the United States. Cantor Fitzgerald is a primary dealer. So in principle, I mean, I think regulators could kind of require Cantor to kind of approach the Fed, for example, to support Tether in the event it finds the
great.
need to satisfy at least its large customers. So the smaller ones, of course, are just left to kind of trade on exchanges or whatsoever. I'm not sure if you have a view on that.
Yeah, I have a quick view. Central banks would be very, very upset if they were called upon to
Yes.
support this.
Being upset, though, they'll still do it, though.
Not necessarily, not in this.
Yeah, James, you wanted to come in on that.
Sure, yeah. I'm just very briefly. I mean, one sort of broader observation is, I think it's interesting to define what we mean by safe, and there are some conflicting perspectives or considerations there, right? Because on the one hand, we're naturally talking about, I guess, the solidity of the peg and the liquidation of the backing assets. The concern I have independently of that in terms of safety, particularly for a solo stablecoin issuer, is how does it operate commercially in a low interest rates environment where actually you could argue a broader and more diversified portfolio of backing assets would give you a degree more security from a corporate lens. But I guess also, and Richard, David, I'd be interested in your views on this. The Bank of England's proposed framework for systemic sterling stablecoins sort of sits a little bit in the middle and considers 40% of reserves being held in the bank in unremunerated deposits, which is an implicit bank guarantee, but provides a degree of safety net around that pool. Does that allay some of it, and does that feel competitive versus the US and EU philosophies, or does it not go far enough?
Is that a backdoor implicit guarantee, Richard?
No, I mean, some people have observed that the Bank of England stipulations will be virtually impossible to meet, and that you won't therefore see much issuance because um, because that backing is too tough in a sense.
Can we move on to a different, another question now, which is that some people have warned that stable coins, if they, are successful as some people, not you, Richard, but some people think that they might be, will risk drawing deposits away from the banking system, and that will pose a risk to the economy and to financial stability. I'd be interested in, what the panel's views are on how seriously this is a risk and what safeguards there are currently to mitigate this. Beth, did you have a view on that?
Sure. And just a clarification, because I do feel like we're having a good discussion, but we're hopping back and forth between opportunities and risks for the issuers and then for use, which in the same way, when you think of um, financial services and a product, the factory maker is different than the distribution. So by way of example, yes, you have to KYC if you're an issuer and someone is purchasing a stable coin from you. But the open question and what I think globally regulators are debating with is those follow-on transactions. Do you need to KYC if you're not the issuer, but you're a service provider, a distributor, you're someone in the ecosystem that's using it? And when I think of the discussion about tokenized deposits versus stable coins, at least from where I sit, and I don't think of it necessarily as a bias because I'm involved in the industry. I think of it as a pragmatic view, in the same way that I know the regulators have over collateralized and required through supervisory agreements reserves that are not in money market funds, that they are in very liquid assets, and you need to be over collateralized. I would say the concern about deposits and the fear of deposits and the banking industry being at risk is more based on a misconception that stablecoins can and should act like deposits, so somehow they can replace or compete with banks. And I do think when you look globally, there's different approaches. I assume there'll be different approaches depending on what the market need is. But when you think of prudentially regulated payment stablecoins, where the issuer has to have a license, it's about the payment rails. It's not about keep your deposits here and somehow the stable coins are going to replace it. So when you think of stable coins, as I had mentioned earlier about the roads, everyone can use the roads. For deposits, you can't. It is a closed walled garden bank and a bank product. So I feel like at the rudimentary part, we're missing that the threat might be for payment processing, but I don't think the deposits is how stable coins are going to be used. And I don't think that is going to impact financial stability. I, of course, understand, and I'm really grateful that we're having this conversation. It's a new concept, and there are lots of different issues to be worked out. But I really think that this one isn't on the top of the list.
Anyone on the panel disagree with that?
Sure. I'd like to comment. I essentially agree with Beth here. One thing I should like to point out too is that the current legislation and even unlegislated Tether, for example, they do not pay interest on the deposits there. Banks, of course, do pay deposit rates and are free to vary that rate. And so we have recently been in a relatively low interest rate environment, and in perhaps individuals or corporate treasurers are not too concerned about keeping their funds in stablecoin entities. But I kind of wonder what happens if inflation starts to take off a bit, interest rates start to rise. What I wonder is whether or not the lobby in the U.S. might lobby Congress for the right to pay interest on stable coins.
Yeah.
And kind of right now, stable coins have kind of a regulation queue on them. And of course, the commercial banks in the United States lobbied successfully to rid themselves of Regulation Q to prevent the funds flowing into the money market sector at the time when inflation and interest rates are rising. I wonder what would happen in that case. Then, Beth, corporate treasurers in particular might find stable coins a very useful way. Their bank deposits aren't fully insured, but stable coins that are fully backed by U.S. Treasury bills might look pretty attractive. And that might, I wonder, pose a threat to the banks, although they could, of course, respond by raising their deposit rates and doing whatever they can to retain deposits. But it would definitely increase the cost of the banking sector, and they would be concerned about that.
Mm.
That's a really great point, David, and you may already know this, which is that is the debate right now with the Clarity Act in the United States. And when you take a look at whether one can pay yield across the globe and the different regulations, it's generally prohibited. But there is a very heated debate right now with the pending US market structure legislation. And right now, the concept is similar to some of the comments when we were taking a look at KYC and some of the other use cases. The issuer would not pay yield. What happens today is if you hold your stable coins and do the payment remittances through another financial institution, that financial institution can pay the yield. So it is not the issuer. The manufacturer still is limited, but it arguably, regardless of where it lands, will mean that banks do need to think about this as changing the status quo and where consumer demand will go.
Thank you. While we're on the banking system, there's a question here from on the chat from Stephen Cacchetti, and I thought that might be with if Stephen doesn't mind me reading it out, I might bring it in now and ask Richard to comment. He asks, what do the panelists think about the MiCA? That's the market in crypto assets regulation in the EU, requirements that stablecoins be redeemable at par on demand and that the issuer holds between 30 to 60% bank deposits. Does this have financial stability implications? Does this have implications for the ability of EU stablecoins to compete with Tether, which is currently in El Salvador? I thought it's a, well, we're talking about banks. Richard, did you have a thought on that?
Steve knows my views perfectly well. We've worked together on these things. So I can briefly say that yes, it could have financial stability implications if there were a run again on a stable coin that then required very rapid drawdown in bank deposits to meet the run. That obviously would have potential financial stability implications. Now that is partly provided for in MiCAR by some limits on how much of the reserves can be in bank deposits, depending on the size of the stable coin. But still, it's an issue, and that's something we're certainly concerned about on the European side.
Thank you. I think we just move on a bit now to the monetary sovereignty piece, which is also part of our discussion today. U.S. Treasury Secretary Scott Bessent has been pretty candid that he sees dollar stable coins as a way to provide cheap funding for the US deficit and to entrench dollar supremacy. And some European policymakers are certainly worried about the potential risks to European monetary sovereignty. Are these fears justified? And what can be done to mitigate the risks? Maybe, David, did you have some thoughts on that?
Yeah, sure. Well, it's not entirely clear what the administration in the United States is thinking. I mean, I thought that they were actually trying to destroy U.S. dollar supremacy. They view the exorbitant privilege as more of a curse, and so they're doing everything to discourage it. Benson's comments were interesting. I'm not sure. I think that it's wide. The comments he made are widely interpreted as him suggesting that the Genius Act would promote the global demand for U.S. Treasury securities more broadly. But I think a more careful reading of what he was suggesting was that it would tilt the demand of U.S. Treasury debt towards bills, and that the overall demand for U.S. Treasury debt might not change very much. So I think he was more talking about tilting the demand, the composition of the demand towards bills, because the legislation, of course, requires the U.S. stable coins to invest heavily in Treasury bills, which are, very, very, very safe.
Yeah. Well, it's hard to imagine the US Treasury issuance being any more tilted towards the short term than than it is at the moment. But anyone else want to come in on this question of monetary sovereignty? Richard?
Well, there is, by the way, an issue about, what if people sell U.S. Treasuries in order to buy stablecoins? They did that on a significant scale. I don't think it's going to happen, but Mr. Besant might think about that if he has time, to, given what else he seems to be thinking about. The dollar supremacy issue, I think, is regarded by many people, including some whom I respect, as an issue here. That if dollar stablecoins expand dramatically, and remember, we're talking about the numbers we're talking about now relative to the size of the financial system, relative to the size of the banking sector, relative to the size of transactions that take place in markets, is still trivial. Okay, but suppose it grows wildly, then I think I know that some European policymakers are very concerned that this will enhance or entrench the supremacy of the dollar in the international financial system, and that is not something that they would like to see happen.
Yes, Beth.
I would just add quickly that there are issuers that have stablecoins that are pegged to other currencies. So although I agree the innovation right now is largely pegged to the US dollar, if conversations like this are helpful and other regions believe that it's worthy of allowing and promoting stablecoins, I think we'll see the global fractionalization in different regions. So I feel as though it's a pretty easy problem to solve. And in the stablecoin standard, there are plenty of non-US denominated issuers. They're just in their infancy. So that's what I would add.
Like they amount to about 1% of the total volume outstanding right now.
Yeah, maybe even less.
Even
But
maybe.
that's why I said it's, if when you talk about evolving trends like this, one can decide to wait and see, right? Or decide it's not going to go anywhere or hop in. I think if there are some that are waiting and seeing, that doesn't necessarily mean that this one issue couldn't be solved by additional issuers in different regions.
The European Central Bank seems to be quite concerned about this issue and is pushing its own European Central Bank digital currency. I'm curious what problem you think that might be solving or there to solve, and what you think of that as how that fits in with what America is doing, the differences in approach. Uh, is this another example of the European precautionary principle towards new technology, or is this and therefore something that a sign that the Europeans are Europe may miss out on a new technological development, or is this a sensible way forward given some of the risks we've discussed around financial stability and monetary sovereignty? Does anyone want to come in on that? Beth, maybe?
Probably will not be a surprise to hear that I do think it's a net positive because although we've talked a little bit about the numbers and how quickly the momentum is coming, I think the numbers I don't think we'll see additional issuers. I think potentially we'll even see a consolidation because one doesn't need to become an issuer to achieve some of the benefits of what we had talked about with global remittances or corporate treasuries. But I do think that that would be a net positive because, as you can hear, I do believe that the benefits that come along with innovating the payment rails are something that is a net positive. I also agree, I think, which was sort of embedded in the question, that having any currency be the dominant currency isn't necessarily advantageous. So having the regional leaders is something that I think would be a net positive. Whether the leaders, there's been a lot of activity out of Singapore and Hong Kong, and likewise as you raised with Europe.
Mm. James, what's your thoughts on the
No, so I mean,
CBDC?
yeah, I mean, I was just going to add a couple of things. I agree with Beth, right? Look, I think lots of these concepts are new, and we're experimenting, and time's going to tell which ones win out. I think the two things, I think first, it's interesting that, as I understand it, the digital euro, is not intended to remotely be a blockchain concept. It's an entirely different concept of programmable digital money, and I don't know all the detail. I'm not hugely close to it. But I guess the two challenges in my mind, or the two things I think, policymakers still need to think about is we're a long way off their planned launch date of 2029. And notwithstanding Richard's comments about the stalling of stablecoin issuance since October, a lot could happen in that market between now and 2029, which might make the move too little too late unless it's then legislated as being sort of foisted upon people. And secondly, I think, frankly, the most critical thing to think about here is interoperability of digital money, and the ability for all these things to coexist and interact with each other. And that gives us optionality and gives us a degree of safety in the future as they evolve.
Mm. So a couple more questions on my mind. Firstly, is the question of, and we touched on this, James touched on this right at the beginning actually, which is the question of financial crime. And it's sort of covered a little bit. I mean, at the moment, there's a perception that some of the biggest users of crypto is sort of illicit finance. So what safeguards can the industry have, or can sort of regulators and policymakers put in place to try and ensure that KYC and AML regulations are observed, or that they are being applied in the digital world as well as in the rest of the financial system? David, can I come to you on that?
Yeah, sure. What is true that the legislation in the United States has for the first time permitted basically what is in effect a digital bearer instrument. This is a regulatory innovation. It's not something technological, and for a long time, bearer instruments have been kind of ruled illegal precisely for the fact that they are supposed to facilitate illicit activity. So there's a question of how one is to monitor kind of these off-chain or on-chain, I should say, movements of funds and transactions. I think that might be very difficult, and regulators are going to have a very difficult time, although I don't know. I mean, perhaps Beth and others might know better than I how they might do that. But I think that the key points that the regulators will focus on are on the off-ramps. And there, I think just standard protocols, I presume, will be put into place. And that, hopefully that does the job. But I'm not an expert in this area, so perhaps others might want to opine and join.
Just one quick comment. most of you will have seen, I'm sure, yesterday's Financial Times article that said that $158 billion worth of digital tokens was sent to crypto wallets controlled by criminals last year. That is according to a report by blockchain intelligence company TRM Labs. This is from the FT yesterday. That's not a trivial sum.
Well, one thing that is true about what you just said, Richard, is that you actually were able to report that. How much of that actually happens today in the existing banking system that we don't know about?
Oh, I'd say the other way around. How much more is there in the crypto system that isn't tracked, right? In off-chain wallets that are, that are not seen.
Beth, what's your thoughts?
Thank you. It's an important conversation, and I would say a few things coming from experience of a few decades leading regulatory compliance programs at banks and traditionally regulated institutions, in the sense that, yes, it's an issue that we need to solve the same way that we want to make sure reserves are secure and liquid and over collateralization allows for operational resiliency. But I do think just like conflating tokenized deposits and payment stable coins, thinking it's just a sense of proportionality. You could look at the TRM Labs report, you could look at Chain Analysis report, then you could look at Europol and UN. We all know in this time and age, there's lots of statistics being thrown about, but there's less, it's about 1% of the transactions that involve illicit finance in stablecoins, and between 3 and 5 in the traditional finance system. And of course, as we've heard a lot, we're in the infancy. That's why I'm glad we're having the panel. This is very early in the maturation curve of this sector. But I would also say that I think it's a misconception that there aren't frameworks and controls and people thinking about actually, let's take the legacy system and then let's make it better. Because the transparency that David has mentioned a few times, there are many, many examples of cyber crimes. The law enforcement across the globe has more transparency than they did prior to the blockchain. So the stablecoin standard is part of our comment letter on the Genius Act because the US regulators have accepted this and said, okay, the legacy system to fight illicit finance created collateral damage. That collateral damage are data incidents. Every person's personal information gets gathered multiple times, and then individuals become vulnerable to data breaches. What if, with this new technology of stablecoins and blockchain, we could have a way to fight illicit finance, which I would say is an inherent risk under any system, and we should expect it. What if we could use the transparency of the blockchain as well as other emerging technologies such as AI to do a better job where we were able to fight the criminals, but we don't put the users at risk by collecting their information and then all the privacy laws that talk about consent when users don't have any way in which they can transact without giving consent. So when you look at, we did a white paper, and in that white paper, you can see that there is an emerging sector on RegTech where we broke it down into 4: prevent, detect, trace, and protect. And you'll see that there are a lot of innovators trying to solve the problem. And I would hope that those innovations would then be able to be applied to legacy finance as well, as because you can hear from my comments today, I think there will be a convergence. We can see that with some of the large banks who already have large digital asset sectors. So I think it's a problem. I think it's solvable and potentially could change the paradigm of over collecting of personal information under the guise of presenting illicit finance. But as we all know as consumers, and probably your audience knows as well, you don't have much choice. You have to give all your information to all the different financial institutions, regardless of whether or not they know that you're not a terrorist or a criminal. And I'd say the last thing on the different statistics about the illicit transactions, they really, it is believed that it's mostly state actors evading sanctions. So I also want to just make sure that we understand we need to solve for it. It's a really great opportunity to do a better job and protect personal privacy. But also, a lot of what we have seen in the spikes relate to sanctions evasion and political issues.
Thanks, Beth. I think we've got quite a lot of questions here from the audience, so I'm quite keen to move on to some of them. So we could start with, there's a question from Andy H here, which raises an important point. Maybe it might be, for the sake of time, easiest if I just uh, read it out rather than unmuting. So in the context of a discussion on monetary sovereignty, isn't there a reciprocal risk so to that discussed for banking stability? Given the anticipated growth of stablecoin to $2 trillion by 2030 and its matching US Treasury holdings, that would make stablecoin issuers equivalent to China and the UK in their holdings of US Treasuries. So what about the scenario where a hostile actor decides to force a run on the digital coin? Wouldn't resulting sales of US Treasury for liquidity purposes risk the sovereign financial system? Anyone want to?
Sure, I'll take that. The
is
answer is no, if the legislation insists that these stable coins operate essentially the way narrow banks are supposed to operate. So if they're holding T-bills, T-bills are usually, I think, even go at a premium in a crisis. There'd be no problem liquidating it. But I go further. I think future legislation might consider even granting stable coins access to Fed master accounts. And I think that would completely, there'd be no problem in facilitating this, the redemption of treasuries if stablecoins had access to Fed master accounts.
That's for sure. But is that wise? Would that be a very sensible thing for the Fed to do?
Well, I mean, the stablecoins are effectively just monetizing the existing treasury debt. And so is that wise? I mean, you're basically providing an additional liquidity aspect to this existing security. So I'm not sure where you're coming from with
I'm coming from the idea that if there's a run, but you're saying that if there's a run, the Fed should pick it up. Okay, so there can't be any runs.
Treasury bills are basically risk-free claims to dollars. So
Yeah,
you're
but
trading one asset for the other.
we go back to the issue of how, selling a lot of treasuries in a very short period of time to deal with a run is not a great idea. And I don't think, to the extent that the assets are indeed treasuries. As I say, Tether's assets, it's not quite clear what proportion are actually treasuries. We don't know, really. Tether doesn't get independently audited. There's an attestation, right, which is not quite the same. So we really don't know. But people don't seem to recognize that there are $1 trillion held in $100 bills, more, almost all, outside the United States, and they evade U.S. controls, and I think there might be some analogies here.
Let's move on to another question. Thanks for that. So this is from Ardik Koka. If stablecoins keep growing, what comparative advantage should a CBDC have to remain relevant for users? Who's got James, do you have a thought on that?
Sure, I can start. I mean, I think there are obviously some fundamental differences between the two, right? One of the things we've discussed throughout this, I guess, but to put it in different languages, it's a question of trust or a question of credit. A CBDC that is effectively backed by a central bank is always going to have a higher degree of trust and resilience than a stable coin, however well managed the backing pool is and however efficient it is. Because as I also said, if we return to what interest rates looked like 2 or 3 years ago, Circle would find it very hard to survive. Certainly with the current stablecoin model. That said, I think there's going to be a healthy competition. I think people will use them for different reasons, and different players will want a different degree of security in the market.
Okay, thanks for that. Here's a question here from Spiros Andriopoulos, the author of the excellent Thin Ice Macroeconomics, recommended to everybody. Should the euro area promote euro-denominated stablecoins?
Well, the chairman of SocGen believes they should, and has written extensively on this point. There are others who disagree. But that goes back to your fundamental assessment of whether you think stablecoins are really a wonderful thing or not. And if you don't, then of course they shouldn't. And if you think that there are financial stability risks here, which I do, then you have to be very careful about it.
Maybe, Richard, you've written a bit about bank tokenized deposits as perhaps as the way to deal with this. Is that the answer?
I haven't really written about it. The person who has written it actually was online, at least before, and may still be, is Steve Cicchetti. Steve and Kim Schoenholz have written a nice piece published by CEPR on tokenized deposits as being, and the bottom line is very simple, that on virtually every criterion you can think of, tokenized deposits dominate stablecoins in terms of their risk characteristics and so forth. So that if you buy that story, which I personally do, and then you say, are the banks going to let stablecoins eat their lunch? You see what I mean? The answer is that the banks will not, and that you'll see a very substantial expansion of tokenized deposits coming from the major banks, which will compete with stablecoins. And as I say, on the various characteristics that are set out in the Cicchetti-Schoenholz piece, pretty well dominate stablecoins.
I'd like, if I don't mind, I'd like to add to that. It's kind of interesting, I think, Richard, that the issue here is all of this would be solved in principle, at least, if stable coins were granted access to the Fed master accounts. But your point, will the commercial banks let these entities eat their lunch? The answer is no, and I agree with you. But here the question arises whether the commercial banks are acting in the interests of society or for themselves, because permitting stable coins to have access to Fed master accounts would in effect put into place the Chicago plan of a narrow banking system that effectively separates the money system and payment system from credit. And in the minds of many economists, that would be actually a socially desirable arrangement of affairs. And it's going to be blocked by the commercial banks. And that's the reason why tokenized deposits dominate, not because they dominate in an absolute sense, but because of the resistance of the commercial banking sector.
Thank you very much. It looks as if we are basically on the dot of 3:30, which was when we're supposed to wrap up. So I'm afraid there are a few questions we haven't managed to get to, which apologies to that. But also a thank you to the panel for a really interesting discussion. The webinar will be put online tomorrow. Personally, I hope that there'll be a transcript too, so that I can go back and mine it for all the fascinating points that the panel made, which I wasn't able to note down while you were talking. So, but thank you very much to Beth, David, James, and Richard. That was really very interesting indeed. So thank you.
Thank you,
Thank
Sam.
you.
Thanks,
Thank you, Savage, for chairing, and thank the National Institute for inviting us.
Thank you.
Thank you.